Returns. I'm Matt here with Garrett. Is that your name, Garrett? And I'll just say it. It's good to have a week where there's not much bad news.
Yeah, it's
Makes us more pleasant, doesn't it?
It's a different vibe this week. We've had several weeks in a row where you talk about like escalation and oil spiking and market selling off. And this week we had a direction flip, which is always nice. Maybe a lot of people listening might be feeling that. You open your account statement, you look at your app, whatever, your retirement accounts, your brokerage account, whatever account you got, 401k. And you probably saw a little positivity this week, which is always good to see.
Yeah, it was really good. It was different, definitely different in a good way. We'll take an honest look at it, look about how much kind of sticks with this headline-driven activity, kind of look under the surface here as the rally is tested, and we'll see what holds. Definitely a lot is kind of riding on this momentum that's been driven this week. So, yeah, we'll dive in.
Not knock on wood. What do you say? Momentum, whatever. I'm going to give you a quick note.
Let's start over.
I'm going to do this.
Welcome back to Good Returns. I'm Matt.
I'm going to give you a quick note before we get into it. Everything on Good Returns is for educational purposes only. We may or may not be your financial advisors, and nothing we say on this podcast is personalized advice for your situation. We kind of are here to give you context, to help you think more clearly, and feel more grounded when you ultimately do, if you choose to sit down with a professional. And I'm going to drink some coffee.
Yeah, well, after you take that sip, tell us market was in fact up.
Yeah, market was up, stock market. So we talked about last week the market seesawing with the ceasefire negotiations and the headlines and how it was very headline driven. Still a very headline driven market. As you can see, it's very evident that that's the case because you have, different things in the market responding to different headlines. Yeah. But this week, for the first time in a while, that headline actually did mean some things.
Yeah. We had a ceasefire agreement over in the Middle East. A lot of contingencies, a lot of things that kind of opaque right now. It's going to be some time to wait and see what comes from all of these discussions. But both sides did, in fact, confirm it, and the market reacted very positively on Wednesday. And that we have not seen. I mean, that was well overdue. Mm-hmm. We've been doing this a long time. We know that days like that are going to happen, but you kind of hit a dry spell where you just are like, man,
well, that's sentiment.
When are we going to have? Yeah, right.
That's
and then
the
you see that big giant pop. Wow.
Yeah, we had the S&P 500 surge 2.5% in a single day. It's got the best single day gain in about a year, actually. The Dow jumped nearly 3%. Russell 2000 gained 3% on Wednesday alone. And the international stocks rallied 3.5%, which makes sense because a lot of countries that import energy from the Middle East have been getting hit hard by the oil spike. And again, this is like the conversation we had last week about context and time frames. Everything is still very short term. This is the way it's trading. It's trading on a short-term manner. You get a headline negotiation, you get a ceasefire or whatever, markets respond. Mm-hmm. You get, we'll talk a little bit about it later, but there's some kind of things going on with Israel and what they're doing, and then the headlines go the other way. So the oil spikes and the oil goes down. So it's very short-term thinking still in sort of the trading mentality that we're going through right now. But it's at least good to see because we have had, like 4 or 5 weeks of negative headlines of markets kind of deteriorating. So to get a couple of weeks, this would be the second week now that's moving in positive direction is a welcome sign of relief, I think, for a lot of people.
Yeah. S&P up 3.7, NASDAQ 4.2, Russell 2.
For the week.
For the week. Russell 2000, 4.3. We're again seeing small cap really outperform. Second consecutive positive week. Both those weeks followed 5 consecutive weeks of decline. So some perspective is warranted. And definitely ground has been recovered. And we'll see, again, how things definitely play out.
Yeah, we talked a little bit about, like, just in our weekly just the conversations that you and I have during the week, after client meetings, before client meetings, we're talking about kind of the context of the market. But we had noticed that, we had noticed the international and kind of emerging market exposure, which has kind of been a consistent theme over the past like year and a half, where those indexes and those investments have tended to perform better than the U.S. And so there's a lot of questions about when that's going to flip, because it doesn't. When that happens, it happens generally for a shorter period of time. It doesn't happen for a very long period of time. So just kind of something to think about. But we had oil falling 11% for the week. Its peak on Wednesday dropped 16% in a single day. The largest single day oil decline since April of 2020. It fell from about 112 to about 94. So it's a pretty big move.
Oh, yeah. Yeah. The VIX also closed below 20 for the first time since late February after having briefly touched 28. Definitely collapsed on the news and the headlines this week. That move in the VIX, which is the volatility index, combined with what has been happening in credit market, tells you that there's probably an undercurrent of things that are going on that may go beyond the headlines. And I'll tell you that when you see a spike in the VIX and that type of a pullback, you have about an 85% probability of the next 6 months being a significant period of outperformance. Very different metrics, very different ways you can look at it. But that when you see that type of activity on the VIX, followed weeks and weeks of declines, then a kind of a spike up, collapse down, you generally have a 6 month period of outperformance. It's around an 85% probability.
Yeah, what you want to see is confirmation from other parts of the market in those scenarios where you want to. You're not looking at just like one area of the market, and that's going to give you more of a confidence that maybe everything is trending in the right direction for the right reasons. And so you saw that credit market kind of confirm that. High yield credit spreads tightened over the past 2 weeks and hit their lowest level since late January. And so when you have all of these asset classes moving kind of in the same direction, everything to our mind is signaling kind of an increase in risk appetite. And it's more credible really than any single market move on its own, because you have the group of them together coming and kind of saying the same thing. And we use a lot of that in our internal conversations when we're talking about asset management too. We want to see this common theme of things, different parts of the market agreeing with each other, because that lends credence in our minds, shores up the argument that we're heading the right direction.
Oh yeah, absolutely. And you did have most sectors participate in the rally in a significant way. Industrials definitely led very strongly up 5.3%, which is an extremely healthy sign. Treasury yields essentially flat. That 10-year really stuck at like 4.3, I believe, 4.3, which is, we'll get to that a little bit later. But yeah, definitely seeing almost all the sectors of the S&P participating in the rally in a significant way, but it was led by industrials, not led by tech.
Yeah, and the caveat here is that the ceasefire, again, is a headline, and it's already being tested before even the week is out. You've got Israel launching strikes across Lebanon, and Iran accusing the U.S. of violating some of the agreements, some of the conditions. So the strait is not open yet. Oil kind of starting to move back up toward 100, but we'll just have to see where it goes.
Yeah, it kind of keeps hitting that resistance for sure, at least over the last month or two. I mean, you can see it keeps hitting a ceiling. It's just very interesting, very interesting. The rally, in fact, is real at the end of the day. Definitely if you're studying this, you're going to look at it sober-mindedly and understand that, there's caution everywhere, especially on how you are exposed to different sectors. If you're overexposed to the oil sector, or if you're overexposed to international or emerging, you may see, you may have some signs for caution potentially, depending on how things move in the short term. But how this all plays out is definitely going to matter. For sure. But let's look at the pending agreements that are out there. It's definitely genuinely different from what we've been dealing with in the past several weeks. We would have times where headlines where you'd have one side saying, one side in the conflict saying one thing, the other side in the conflict saying the other. But now you're actually starting to see both sides kind of confirming things. And I think the market's picking up on that. The market does generally, when you start seeing big movements that are consistent over days, and you start looking at everything from the VIX to credit to the sector movements, when you start seeing everything kind of moving in a risk-on appetite, they're picking up on something. So, it's a meaningful whatever is going on is meaningful to the market for sure.
Yeah, I definitely took it seriously.
Which is to say whatever. We don't know, right?
Well, it could be. It can
really
also speak to the desperation. Like there is a real desperation out there amongst most investors. Like this something has to give. This got to stop. Investors tend to not like long bouts of increased volatility, which is understandable.
And uncertainty.
Yeah, and uncertainty, which goes alongside that.
I'm kind of working on an expansion of my thesis of the deflationary story, the tech-driven deflationary story, and what that means and the second and third order effects. And it's very possible that an element of what we're seeing is not as much that conflict resolution is important to market participants as much as it is the quicker that it is resolved, we have de facto stimulus from the global strategic petroleum reserves that have been released. And the cessation of blockage means the free flow of all that oil that's been crammed up. And so now you have the markets, essentially it's a stimulus effect where yes, the price went up, but then you had response mechanisms across the world dumping oil into the markets. And then now if everything begins to open back up, you're sitting on a huge supply of oil, which you're going to see the price of oil collapse, which creates a stimulus effect to the global population. I mean, it is very possible that the price of oil, when all this stuff is said and done, that the price of oil is lower than when it was when all of it started, and lower in a meaningful way.
Well, you've already seen some analysts, they're not changing their outlook for oil. There are still some analysts out there, I don't know how many of them, I've seen a couple that are still got their oil price, around the 70s by the end of the year. Even considering all of this, it's not making them readjust their expectations.
No, not in the slightest. But regardless, and it is naive to assume that any one headline tells the truth, or that our perspectives on these international disagreements. All we can do is look at what the data in the markets are telling us.
Right.
And it's definitely good to feel okay about the recent developments, both in the market, both in the stock market, in the credit markets, and in the commodity markets. Because there's been weeks of difficult news. Difficult news will, in fact, over a long period of time, make difficult markets. But the genuine agreement that is being looked at from all sides is definitely a step towards risk on appetite. On appetite in the short term, which we know, and a lot of this really is to look at things in the short term, which as investors we don't do. We take a long-term picture. So this is more, it's important to pay attention. If you're going to pay attention to the short term, you could justify it by saying that it helps you build confidence in your long-term plan, because you watch all these reactionary players do this, do that, and then 6 months go by and you're like, what was that I was worried about? I have forgotten.
Yeah, but this actually brings up a really good point, which is that sometimes, and it's hard to tell in the moment, but sometimes you get these little pockets of what we would consider opportunity, like buying opportunity in the market when you have events like this that allow for you to have a lower entry point into the market, because it's not something that is, the environment that you're in a short term is not endemic of something that is longer term, is going to affect things in the longer term. And so that's sort of the thing that you have to wrap your mind around. And it's not fun because, at every opportunity when you're like, oh, this is a good opportunity to buy. We get that question a lot, constantly. When is there a better opportunity to buy than not? And it's kind of a funny question because, we talked last week about you can pull up a chart of the S&P or whatever and point to somewhere, and there's never really a terrible time to invest. But people tend to ask that question, is there a good time to invest? But when the time comes that is a good time to invest, then you get a different problem, because then they're like, oh, I don't know if I should invest.
Yeah.
Should I invest?
If you're on the sidelines,
but you have to look at
the moment, if you are on the sidelines,
yeah,
and you haven't been investing, it is both simultaneously the best time when things are bad for you to do that, but the hardest time for you to make that decision. It's hard, but you have to have perspective. if we kind of jump ahead in the discussion to the oil situation, for instance, you may hesitate or you may doubt your plan because the price of gas went up at the pump, and then one thing happens and price drops like that. Oil is notoriously volatile.
Right.
And so you have to zoom out and you have to understand that, these past few weeks have been dominated by oil up, market down headlines. But what dominated the headlines this time last year? It was oil down, tariffs up.
Yeah, the tariffs.
What dominated the year before that? 2024. I'm sure if I thought for a moment, we could, figure out what was kind of going on in March and April. So you could just keep going on. There's always a reason to be concerned, but the greatest concern of all that you should have as an investor is how much are you going to let your wealth disappear to inflation and debasement over the next 20 years? That's the real concern, because you can take your you could take $100,000 and set it on this table, lock the door, and come back in 20 years. And when you come back, you'll count. There will be, in fact, $100,000 sitting here.
Maybe.
Right? There will be, but it will not be able to buy what $100,000 today buys. So it is worth less. You have by locking it away and not doing anything, you have guaranteed to lose 40% of that money over 20 years. It's just a guarantee. So that's the biggest concern that people should have. But it's such human nature to be drawn in to the day to day and to what's going on. And then
I think it's like it's always at a certain period, it's always sort of conjecture. You're always looking at the data and you're always looking at the environment that you're in, and you're always trying to make a guess, basically. And I think that kind of causes a lot of people concern that they don't want to necessarily make that guess, but sometimes you just have to. If you look forward at, potential earnings, or, if you look at other things like we're talking about, where all these kind of markets and all the data seems to be heading in one direction, like that's a positive outlook. It's not the opposite. I mean, if we were sitting here and talking about all of these numbers kind of pointing to a concern, or, I guess that's how I would phrase it. It's an interesting question, and I get it. It's very emotional. Finances, investing, all of it's very emotional for people. But at a certain point, you just have to set that to the side and just start. I mean, you just have to start.
Yeah, and you have to ignore the short-term stuff.
And what if you get in at the worst time?
Yeah, just wait.
If you're a long-term investor,
it doesn't matter. Just wait.
It doesn't matter. That's all right.
Yeah, just wait. Don't worry about it. So moving ahead to briefly circle back to my least favorite topic on our good return shows for the past 6 weeks, which is oil. The reversal was in fact fast, as we stated. You can't look at what's happening in the oil markets and think there is an absolute resolution. There's definitely not, but there's some interesting things that are happening. The moment you had that one-day decline earlier this week, expectations for the Federal Reserve rate cut immediately came back into the picture. And then today,
that's what. That's why we always say you can't put a lot of stock into that.
Yeah, it's what was it 2 weeks ago? It's like the market predictors were a bunch of hand wringing. Oh, the Fed may raise rates. Yeah. Literally 14 days later, the same people are saying, "Yep, the Fed's going to cut." Now, you heard it here first, folks. I told you that the Fed is going to cut, and the downward trajectory for rates is absolutely to the downside. Today, CPI came out. The Fed pays attention to what's called the core, or they tell us they pay attention to what's called the core CPI.
Sometimes they pay attention.
Core strips out, quote, volatile food and energy.
Right.
So if you look at the core, we had another print lower than expectations. Deflationary pressure. The trend for CPI, regardless of how you measure it.
This is first quarter CPI?
This is last month.
Last month, okay.
Yeah, last month CPI, March. So the trend that is happening, regardless of why it's happening, is there is an undercurrent of deflationary pressure that is building, and it is strengthening month after month. I tend to hold the belief, I believe you do as well, that is primarily being driven by technology, artificial intelligence, electrification of transportation. But there's a significant, just think logically here. Let's just follow me for a second. Let us look at what the value, let's have a little thought experiment here in real time.
I can't wait. I'm waiting with bated breath.
One second. It's computing.
Progress.
It's thinking. Okay. If we go back to peak oil in 2008 and we adjust that for inflation, out of all this chaos going on in the world and with the oil markets, we touched 120, but it basically settled on West Texas, like between 100 and 110. It's kind of floated. It touched that 120 very quickly, came right back down. It's been back to 95. So let's call it on average $100 a barrel. Adjusted for inflation from $2008 to today, for us to hit the 2008 peak, oil would have to be over $210 a barrel. Okay? What we just went through was the largest disruption of the flow of energy in world history, and adjusted for inflation, we are less than 50% of the peak oil price in 2008. That tells you that there is a strong gravitational pull for the prices of things downward, especially commodities, especially oil, obviously. So when you see that, and then you look at these whipsaw effects, and then I was speaking about the strategic petroleum reserve. It's, to me, I'm beginning to look that the market may be headline driven, but it may be stimulus seeking, to where any relief anywhere that could be stimulative at all is jumped on by traders, and
that's kind of like the desperation.
Well, that holds true if the deflationary current is strong, as I believe that it is under the surface, and you're starting to enter that period of time, then the market must have stimulus. It must have stimulus in a deflationary period. And so, I don't know, we'll see how things develop, but the more that this goes on, the more I begin to suspect that the headline-driven activity is true. We see it. But I think it may be beyond algorithmic trading, and it may be beyond kind of on the nose moves, right? Disruption in oil makes oil go up, ergo I trade oil futures, and may be more, in fact, pointing to we are entering an era where stimulus is going to become extremely important to market volatility.
So how do you square that with commodities in a downtrend, looking at gold and silver?
Well, gold is going to be a different animal because its industrial use is nowhere near its monetary value. So gold is going to pick up on the debasement of currency. So it's also going to be stimulus driven. The expansion of money supply is going to hold gold into its bull market, which gold is still staying in its bull market, even though it's had some periods of retraction that have been pretty significant. Silver is industrial. That's why it cannot maintain its significant bull run. I don't even think it's gotten back over its. I think it's still below. Let me see here. Why is that so hard to find? Yeah, stuck at 75. So silver's going to.
I mean, if you look at that compared to like what everything else is doing, it's still moving in a positive direction. We still have the S&P down. Is it still down year to date? Let me look.
I don't know. We're doing some real time.
This is real time, people. This is real time.
No, it's flat. Call it flat.
So
call it flat.
We've gained a lot of ground then.
I don't know how you square it. Again, it's got to be thought through, and it's more of a thought exercise as you kind of build out and square your optimism and understanding the market does go up and then look at reasons as to why, because each period of time is different as to why it goes up. Every 20-year period you look at, it's different. It's not the same story.
Well, that's the argument for diversification, to where you don't just go into an S&P 500 fund. It may be enticing to do that, a very low cost way to do that. And it may work, and it's probably going to work out for you over a long 30 to 40 year period of time. It'll work out for you. It'll be difficult on the downside when you start having to withdraw that income to be that concentrated. That's going to be a little more difficult. So you do have to kind of think about that. But that's the argument for diversification. We already talked about that last week and I think the week before. But you have some areas of the market that are like silver up 5 or 6% year to date, and you've got the S&P, which is flat. And so therein lies the very real world, like you can see it, the benefit of adding different asset classes, and whether that's gold or whether that's, something in the crypto space or something international exposure, emerging markets exposure. I mean, some of these things you don't necessarily want to hold all the time. We have gold indicators that we look at. There are positions. There are times where we do hold gold positions. There are times where we don't want to be in gold positions. So there is that sort of sense of active management there. But it does help.
No, it does, because you don't know until you know, and by then the actionable steps that you could have taken, the time has passed for it. So when we're talking about these things, there's a bifurcated mentality here, which is portfolio construction and asset management is driven by data. It is driven by a certain methodology that we believe sets our clients up for the most success that they can have relative to the risk that they take. Now, then on the other hand, when you are speaking like we're talking about now, which is just trying to construct a thesis to try to have a framework for how you're viewing all these changes that are taking place in the world, that really doesn't lead very often to actionable advice. It's more or less of a thought experiment in trying to understand where things are going in the market. And because very seldom does that lead to anything actionable, you have to be able to think all these things, but at the same time, if the data is saying, hey, listen, the Russell 2000 or the S&P equal weight or international is where your greatest risk reward is at, then you do that. You look at the data and you pay attention to it.
Right.
But all this being said, I think that we're continuing to see that the risk is not, I believe the risk is not inflation. I think the risk is deflation. And I think that if we continue to see the types of activities that we saw this week, it'll just further prove that out. Now, next month, we do have the new Federal Reserve Chairman that is coming into play. And we'll see how that rate cut story evolves mid-May, I think. I'm not sure when the first meeting is after.
I mean, the other thing there is Powell's still going to be on the board. So I would say that the more interesting thing is to look at is going to be when all of that gets settled with the DOJ lawsuit or whatever they're going to do with that, and he actually moves on. I don't know how much weight he will have as, the former, that would be kind of daunting, the former Federal Reserve Chairman sitting in the meeting with you as you're trying to come into the position as his successor.
Yeah.
But neither here nor there. It'd be interesting to watch though.
Yeah. It's very interesting. But let's get back to the data as we progress here and look at the credit markets.
We always have a hard time staying on this.
Well, I mean, it's interesting. That's what we want to tell you what we're thinking about. And it doesn't mean, we're human just like everybody else. We have thoughts. We try to figure out why things are happening. We're either proven right or we're proven wrong. We look at the data. We make informed decisions. But just from, again, that bifurcated perspective of where here's our thoughts and guesses. Don't ever misinterpret that as this is our asset allocation instructions. Two completely separate things. And that's what makes us very good at what we do, is being able to separate opinion and bias from actionable real world advice that is designed for a meaningful contribution to your retirement plan over a period of time. So, but let's look at credit markets. We don't talk a lot about credit markets.
Yeah,
we just
there's a reason we don't talk a lot about credit
if people are driving and they're listening to us talk about bonds, they're going to fall asleep and wreck.
Yeah.
So if you are driving and we're to the credit market discussion now, make sure to give yourself a good slap in the face, a sip of coffee, stay awake. But let's talk a little bit about it because You can get a lot of information from the credit markets.
Well, it's just exactly what we talked about a minute ago, which is the confirmation signal. And so, maybe your average investor, I guess, maybe doesn't really put a lot of stock into the credit markets because that's not what's talked about a lot, unless you're in a period of time like 2022 where you had stocks and bonds kind of at a parity, where they were both just in free fall. So there's always a question when stocks go up. Is this a real rally, or is it just the market getting excited? And so one of the things we look at to determine that is other parts of the market, as we've already said, but credit markets fall into that as well.
Yeah, the definitely the entire stock market was convinced that something meaningful had changed this week. Something the big money, in fact, is convinced. Credit spreads tightened significantly. And what that means is that the bond market is saying that the credit risk for corporations has improved. Mm-hmm. It's an improved risk environment. The volatility, again, going down to 20 or closing below 20, the VIX closing below 20. What that is the options market. So the calls, the puts, the options market is saying that they expect volatility. Volatility already has dropped or will drop meaningfully. Both of those moved in the same direction as stocks.
Yeah, when we see all those three kind of move in lockstep, they kind of confirm it's much more credible for us than just stocks alone. It suggests the rally actually does, reflect some genuine improvement, and it might have legs. It's not just across equities.
Yeah, credit spreads are now back to where they were, late January, before all of this stuff started. It's a meaningful reset. So as always, it doesn't mean everything's rosy and the uncertainty goes away, but it does mean the financial system writ large is not pricing in stress and credit stress the way it was just like 3 weeks ago.
Yeah.
So again, this is really good. You're living, if you're new to this and you're listening to this, you are in real time living why we say ignore the noise, stay focused on your plan, do not make any brash movements, work with a professional, let them design a portfolio for you that is time tested, that is there to endure AI disruption. It's there to benefit from AI disruption. It's there to take you through the good and the bad times so that you compound and grow your wealth meaningfully. And you're living through, we're seeing 3 weeks ago, it was bad, bad, bad. And now everybody's like, huh? What happened?
Yeah.
That's the way the market is that's the way we're reading this data and interpreting it. It's basically the market saying, do what? And it's very interesting. And we've seen this time and time again. But it's interesting to live through it every time, and you get a little sharper as time goes on and being able to kind of see think in COVID. Oh my God, think of that, right? March, April, Armageddon, end of the world, right? By the time August got here, I mean, the craziest things had happened in the market. I mean, it was a good
buying opportunity.
Oh,
again,
my goodness.
Going back to the fact that the best buying opportunities are.
That was definitely something. But a little bit more into credit. Tell me about treasuries. I need to be informed here about treasuries.
I mean, we have. Let's see, we're coming up on. Yeah.
Do we need to skip treasuries? I'm all for it.
No, we can talk about
I'm
treasuries.
100%.
I mean, one of the things that kind of got lost in the excitement of the stock rally is the treasury yields barely moved. You already talked about that earlier, but the 10-year ended the week around 4.3%, down less than 5 basis points, despite one of the strongest week markets of the year. This is one of the strongest stock market weeks of the year, rather.
So that part, the treasury part of the market, so you don't really have credit risk with treasuries. So you can't interpret kind of what's going on with the credit spreads and corporate debt and then say, okay, well, that's telling us everything. But the treasury, I think the treasury market is waiting more on the Fed. That's really what I think than anything else. And your 10 years kind of what drives corporate lending, basically. I mean, it's all tethered together as far as what small businesses and things pay in mortgages really closely more correlate to the move in the 10-year than other things. But I think that's really kind of the wait and see approach that's going on there. Is your treasury they're just waiting to see what the Federal Reserve does. So
yeah, the stock market's kind of pricing in the possibility of a better outcome, and the bond market is just sort of saying, show me. And that's that's okay. Bonds investors, they want to see oil stay down. They want the inflation data to confirm it. They want the Federal Reserve to respond. It's a more typically a more conservative audience in the bonds. I mean, you think about retirees with muni bonds and other type of bonds. So in this type of environment where we're in now, duration really matters, which is how long your exposure is to those bonds. What is it, a 20-year bond? Is it a 3-month T-bill? I mean, what are we looking at on the corporate and the treasury
and
side?
It is good to see some difference in movements between the stocks and the bonds. It's good diversified portfolios benefit from that. But if both were acting like simultaneously in like a rip-roaring way, then it would really tell you one of them's wrong, right? So the fact that you are, with the treasury market in particular, seeing kind of a wait-and-see approach to things, and then you have the stocks. It's hard
today. It's a Friday.
The stocks acting in a very risk-on manner. It kind of says equities are pricing in resolution, and some parts of the bond market and the treasury market in particular is more like, let's just see how things play out. So that's an interesting and healthy dynamic that we are paying very close
there's also a methodology for bond investing that some people follow, where in more turbulent markets, you may end up going more toward the treasury side, looking for quality basically. And then when you're in a risk-on environment, you go more to the corporate side because you're less concerned about that. So that's an interesting way to look at it. I know that a lot of people I follow that are of that opinion are still in the corporate debt world. They haven't moved over. So that's another kind of piece of another data point that's interesting. I mean, they could be wrong, but it's interesting to look at.
Yeah. So moving ahead here, getting out of the bond market and going into,
we'll come back to the bond market.
Going
Recurring
to
theme.
earning season.
Yep.
Earning season's coming up. If you're new to investing, every 3 months, every publicly traded company reports its financial results, how much it made, how much it spent, what its projections are. And the last part, which is the expectations, kind of where do we think things are going to go, is what can sometimes drive stock prices the most. So even if a company beats its earnings, but if management isn't really guiding, you can see some reaction. So this upcoming month here, this earnings season we're about to enter into, is going to be very interesting to pay attention to see if it does in fact confirm the broadening of the bull market, the strength of the public equities in the U.S. So we'll be monitoring that, bringing you some interesting information for you to kind of look at the math and the numbers, and then what people's expectations are. And it'll be interesting to see, how did March play into, this coming up earnings season.
I think the projections are going to be the most important thing to look at there. You're going to see a lot of people kind of watch for what companies think they might have to do in the future. Are they lowering guidance? Are they concerned about these hits in the energy sector? So that'd be interesting to watch.
Yeah, absolutely. Well, we've talked about a lot. We've talked about a lot, and we'll continue to digest all of this data for you and this information, and kind of try to do a healthy mix of what has happened, what's currently happening, and then, maybe again, some broader framework, some differences of opinion about what all does this mean and where is this heading. We like to distill that all down for you and give you something interesting. And in that theme, we want to give you something interesting in the planning room, which is something to keep top of mind. We help lots of retirees every single week develop and execute a healthy retirement plan, a healthy asset allocation plan, and income plans. And a part of that quite often is people don't really realize that once you're at the age of 59 and a half, and even though you're not taking Social Security, even though you may still be working, you have the option to do what's called an in-service rollover. And that can be a great opportunity to sit down and speak with a financial advisor. And if you don't have one, go to momentumwealth.us. We'll be more than happy to speak to you about your situation. Clients in, I believe now, 11 different states. So we can work with you anywhere in the U.S. But sit down with your financial advisor and start making that retirement plan and that income plan now. And it's a great opportunity to say, okay, I've reached 59 and a half. I'm eligible for what's called an in-service while I am still working rollover. And you can begin to get those assets into places that are going to go ahead and start working for you as if you're already retired. So you can get used to the asset allocation. You can understand where your income stream is coming from. And it makes the decision of when to retire so much easier because you're not at 61 or 62 having all these decisions to make because you know you're about to have your last paycheck from your job, but you haven't really given much thought to what does investing look like outside of my 401k? How do I get income? How do I have sustainable income? So it's a often overlooked opportunity if you're getting close to 59 and a half to really understand if an in-service rollover can benefit you and if it makes sense. And of course, there are situations where it doesn't make sense to do. But more often than not, it's a really great strategy to establish a relationship with a financial advisor and begin to get those assets allocated the way they need to be for retirement. And it's a great tool. We have used that successfully many times. We have clients that are maybe unsure. Like, listen, I know I'm getting near the end of this thing. I can't take being here at work much more. I'm about done. But it could be 2 more years or 3 more years. But I need to figure out, how do I get this $500,000? How do I get this $400,000 allocated right now so that if it is next week, I'm good to go. I can get my income started. I know how everything works. I know what assets I'm in. I understand the plan. I have confidence in my money management firm to use the data to allocate to the assets that are going to help make me the money that I need to live on. So, that's a big often overlooked tactic.
Yeah. Well said. Well, we're coming to the end. It's another long one this week, but we appreciate anybody who joined us. That's kind of it for us here at Good Returns. We just kind of wait and see all this headline stuff. Just take a step back, look at the 30,000 foot view, and we'll see where it takes us.
You had a completely different topic for the planning,
Yep.
for the planning, and I did not realize that.
It's all right.
It's all right. We're flying by the seat of our pants here. So we'll cover the topics that Garrett actually put in here for me to talk about next week. Well, we had a brief discussion. I didn't realize that it wasn't in there.
No worries. This is what happens sometimes on the fly. You know that we stray from these notes. We try to have a format here to follow so that it makes sense, but we strayed this week.
Well, he had the coffee. I only had the Coke Zero.
It's all gone now. I need to top off.
Yeah, I know.
Anyway, that's Good Returns. Thanks for spending time with us. Good conversation, useful information. Hopes it leads to something insightful for you. Subscribe if you haven't. Share it with somebody you think will get value from it. And we will see you back here.